So I come from the hairy side of the deal world, and I was just kind of curious about the speed bumps that you talked about. If you're able to describe what was the largest surprise that you found when you were doing the deal?
Largest surprise when we did the deal.
Well, I'll speak. So we did 2 transactions before we sold to Berger, and I would think that the second transaction had more speed bumps than the first transaction. Part of that was driven by an election, the speed at which Afghanistan and Iraq were sort of going to be unwound, if you will. We had some customer concentration in there, which I think got highlighted by that as well. And we had some issues in terms of the management team we bought the company from, and the chemistry and how that fit went, and their sort of prerogative. It's a high-paced, high-pressure world that Steve alluded to with private equity, and I don't think that the fit there was as good as it could have been or had to be, and so we had to make some changes along the way that I think were somewhat unforeseen, but again, I think handled in stride, if you will, along the way. But Kirk, I don't know if you want to.
Yeah, I'll just build on that a little bit. And I sort of think about the speed bumps in this situation in 2 categories. And the first category is really people. And I think Seth hit it on the head there. And I think anytime you have a successful entrepreneurial business that is being acquired by another successful entrepreneurial business, there are personalities at play. And I think it was a pretty hard personality on the other side there that Steve did a really good job of soothing and managing and doing everything you need to do to nudge those companies together and make it work out, which is not easy to do. And the other is really integration. So there are a whole slew of things from accounting to processes to, hey, we do it this way because this is the right way to do it. And I think, again, it takes a very good management team to be able to handle that and integrate and really, bring the 2 businesses to the same high level of professionalism. So I give Steve a lot of credit in handling the people side of that very well, and also handling the execution side of each of the individual factors very well.
And let me add from a slightly different perspective as the investment banker working on the deal during the sale process. I think for me it really came down to one word, and we kind of alluded to it earlier, sequestration. Because we really were in the middle of a process when this budget crisis, debt crisis fight was going on in Washington. And as you can see, this company derives a fair amount of its revenue from the government. So when the sequestration failed, literally we were with final bids, and there were a number of companies that didn't know if they really had the conviction and the commitment. There were quite a few that did, but the ideal at that point was to refocus on companies that really understood the story and had the foresight, the ability to think forward. Where were we going, and where does this company sit with respect to the budget? So it was an opportunity to, I think, really witness the best of, I guess in those situations you either witness the best or the worst of people. And fortunately, we experienced the best of everyone who really decided, let's spend some time and understand the story and where this business is going.
Warren, I have to agree. I mean, to me, the deal was, well put together. I think everybody had a goal. You guys had the goal of selling the business. Steve had a goal of continuing to grow the business, and we had the goal of picking that up and taking off where these guys left off. So, I mean, I ultimately think at the end, even though I apparently overpaid.
Underpaid. Underpaid.
It's worked out the best for everybody, I think.
Hey, Luke, every strategic buyer that bought companies from Ranger complained that they overpaid. I think that's great.
In fact, all of them underpaid.
No, in fact, in retrospect, though, no, I mean it. And if you look back on each one, and I think we're going to have this as a look back in about 5 years, each one of those strategic buyers points to that enterprise that they bought and says, wow, that was a good deal. ACG today has 9,000 people in 100 airports. Keystone, that little $40 million company that I bought with you 10 years ago, is now $700 million in the centerpiece of Sikorsky's aftermarket. So You know, as they say in Texas, hide and watch. We're going to grow this piece of the Berger Group to 300 or 400 million before I'm done.
Yes.
Yeah, another question.
Go for one in the back next.
Yeah, this is a question. This is a question for Warren. Warren, you mentioned a number of compromises that had to be made. Could you talk about one or two of those compromises?
The earnout's probably a good one.
Yeah, that's probably the biggest compromise of all.
Yeah.
So I think clearly the team did a really good job of running this company, putting it in a position to grow, making some significant investments in a couple of opportunities. One was Saudi Arabia, and the other was obviously the relationship that we had with BAE. And everyone knew that they were on the cusp of really expanding some of those opportunities. And we spent a lot of time hammering out structures that will reward the owners to the extent that things went well going forward in new ownership, both owners. And then what we saw actually right at the closing, one of those came to fruition, I think the day of closing. So it was identifying those obstacles and finding willing parties to discuss them so that there were open and frank conversations about what parties wanted and what others were willing to provide in both compensation and opportunity. Because I think on many of those opportunities, Steve, one of the things that Berger was willing to provide because they believed in the management team was some autonomy and independence on going and prosecuting some of that business.
Yeah, there were two big accounts that had that type of trajectory factor on them. BAE Systems, a huge government services contractor, is one of our biggest clients, and they renew their business with us each year, and as it renews, there's an earn-out formula attached to that that's appropriate. And then there was essentially a joint venture style project that could have takeoff factor in Saudi Arabia. So Berger Group appropriately put some metrics on a multi-year basis to the BAE account. And then on Saudi Arabia, since business there is difficult, nebulous, and follows a very unusual calendar, they agreed that, okay, it could have some very strong formulaic reward, but only if it happens within the next year. And so on that account, I don't mind reporting to you tonight that on that Saudi Arabian account, I actually think that in about 6 or 8 months, we'll see contract fruit bearing out of our efforts for the last 2.5 years in Saudi Arabia. Sorry, guys. I know. No, I'm serious. I mean, we're actually seeing that things might start glimmering over there for us, perhaps. So it went past the deadline, but frankly, it'll still be good business for Berger Group.
Yeah. And I think from our standpoint, putting the earn out on the BAE, and the way to describe it is that most of the contracts we have are 5-year contracts. BAE happened to be 25% of the revenue stream, and it was 1-year contracts.
1-year renewals.
So for us, it minimized the risk that if that revenue didn't keep coming back, we didn't overpay.
Right. But it allowed us to bridge a gap between the price.
It was a win-win.
Yeah, absolutely. That's why I say it might have been an obstacle, but I think we all came to the table and solved it. So.
Yeah.
Yeah, this question is for Steve. Steve, it sounds like your vision when you started the company was to sell to a strategic, but perhaps you could sort of tell us about the dynamic that you had with Warren and as well as your owners. As you're getting ready to go to market, sort of did you go rather broad? Did you target specific corporate entities, or sort of walk us through that process and how that worked out?
Sure. We made a decision at the board level, and also my management colleagues fully embraced the decision as well. So everybody was solidly on board with what the strategy was for the contemplated exit. Secondly, then, we vetted 6 investment banks, as I said, to select Houlihan as what we thought was the most expert partner in sector. Then third, with them, they developed a go-to-market strategy as to how was this going to get done. They presented us with broad or narrow, short list or big list, and we decided to go with a relatively broad net on the initial round. From there, we quickly reduced it down to about 20 viable interested parties making indicative offers. We then met with 13 of those, skinning that down to about 3 or 4, and ultimately singling up with Berger Group. But go ahead.
I would just add to that. So we went broad, and broad meant strategic as well as financial buyers.
Right.
I think that from a board level and from an institutional level, there's a sort of a bias that we felt we could get potentially a better multiple from a strategic buyer who, would look at the business, value the business potentially different, could look at some synergies, cost and revenue side of the equation. But we also canvassed the financial buyer market pretty extensively as well. I think that when we got into the budget shutdown and the uncertainty, if you will, in that marketplace, it really impacted the financial buyer side of that market. The leverage available to lever a buyout at that point in time really started to impact their ability on valuation. So we went out pretty broad. We had a strategic buyer list, a financial buyer list. Some of those financial buyers were sort of strategic in nature. But at the end of the day, I think when we started the process, I think we hoped for a strategic buyer, and I think we had a better than 60% chance think we'd end up with a strategic buyer. And again, a lot of compliments flying around here. When we looked at the banker list of the 6 that we interviewed, a lot of it had to do with where those relationships resided with the strategic buyers that we thought we were going to be a good fit for. And Houlihan definitely had the most robust set of relationships that, and we thought would serve us well.
So this question is for Steve and Luke. In buying the company, what were some of the synergies that you saw taking Ranger in-house, and because it was a standalone entity, what value could you find, and have you since done so?
Sure. I think that one synergy, or starting off entrepreneurial based, Berger's been entrepreneurial since the beginning, and we look for guys that are out there trying to win work and do it. Synergy, government contracts, government clients, but diverse markets. Steve was in the O&M business, fixing vehicles, putting packages on planes. We didn't have any of that on the O&M side from the government. We were providing power to the government on some Army bases and some other stuff. So it gave us other inlays. From Steve's standpoint, he wasn't that much overseas, where we've got a lot of capacity to go overseas. So we saw an opportunity to continue to grow the business. And even picking up Hawthorne was an add to that, because they're providing fueling services on DoD sites in the U.S. We have a lot of contacts to put that overseas, so we saw a lot of opportunity to, even though there was areas where we had some overlap, it wasn't a lot, so there was a lot of growth opportunity.
And to build on that, to your question about synergies and why do we do it, for the first 3 or 4 months, everybody was getting acquainted, going through the egg walk of just getting acquainted. But once we got past that, once we got past the first few months of just simply 2 organizations getting acquainted, we began doing weekly marketing conference calls among the business development operatives of 3 units of Berger Group, ourselves and 2 others. We began looking at not just pie-in-the-sky wish lists, but specific hard contract bids that we thought that we could win more on if we bid on them together. And we have 10 in our top 10 hit list right now that we're working on really hard. The global footprint was important. The global footprint was very important. Right now, we're bidding on a huge air-based support contract in both Turkey and Spain. We're doing it in concert with the Washington, D.C. unit of Berger Group Holdings. We could never have touched that without them. And frankly, because of everything we do at air bases, they are greatly enhanced because we're now their operating partner, essentially. And then last but not least, there's a lot to like about a 60-year brand that is really well known around the world. The Louis Berger brand, going back to Doc Berger himself, is a very, very well-known brand in our sector. And despite the fact that I was intensely proud of my 15-year Ranger brand, started at my kitchen table, how long did it take, Luke? It took me about 5 minutes to get this organization instantly rebranded to the bigger, better global brand. So we've taken a lot of advantage of it, and we're looking for more. That's why I'm going to be in Washington, like I said, on Monday and Tuesday with new colleagues, finding new ways to grow business together. That to me is hot.
Somebody in the back. One more in the back.
I think the question is for Seth. You mentioned earlier that you guys were having a debate at the board level about going for top-line revenue versus profit margin. I don't believe you had mentioned what you decided on doing. Mm-hmm. And then this question, I guess anybody can answer, where does that decision stand now?
Mm-hmm. So we did have that debate. I'm sure that debate is ongoing in a lot of our businesses. That debate is out there. We looked at and valued scale. We felt that scale, top-line scale, that is, was going to be important to us, and potentially to a suitor for us. However, we also felt that our margins at the time were also something that was going to be attractive to a buyer. We were, competing in and some less of the fixed price contracts and more of the sort of variable price contracts. And our margins were, we thought, attractive to a potential buyer. So while we wanted to grow the top line to scale, we were very sensitive, and I think the desire to keep the margin where it was at the end of the day won out. And that we felt like we would have diluted our story too much if we had taken on, even if it was 5-year contracts at lower prices, that we were going to let the folks come down market and do those things, and we weren't going to sacrifice our margin for that. I don't know if Steve or Kirk want to add anything to that, but I'd be interested to know if you thought that strategy was correct.
This industry has profit margins that you look for a certain range in, and if it had been below that, I'm not sure we would have continued to look. Historically, Berger always had an approach of buying what they call fallen angels. We've changed that philosophy. It takes a lot to keep trying to turn around small businesses and make them profitable. So we were looking for companies that were in that range, and we found one with Ranger.
On margins, though, I do think that we're looking at a new reality that is kicking into a new gear tomorrow. I'm not a doomsdayer about sequestration. I don't think it'll be as bad as we are hearing about, but it will affect. What we're seeing is some of the bigger companies, the big dogs coming down into our neighborhood hungry, looking for lunch. We're seeing pricing and margin pressure on new bids. We're seeing more intense competition. Those are all interesting new factors. So I think in the next few years, we're going to see an interesting set of decisions that we have to make together, Luke, as we go forward on backlog versus margin, because you have to have both. Mm-hmm. When you win something, if you wanted to make 11%, and that new reality of these types of funding pressures forces you to grab it at 8%, you do win 5 years worth of backlog. And in a billion-dollar context with a global enterprise, things will come back, and if we've grabbed that share, there's merit to thinking about on both sides of that coin.
It's a very good question.
It's a zinger right now.
Yeah.
Yeah, it really is.
Yeah.
Well, I think that's it for the questions. I want to obviously thank our panelists again, and then also thank ACG and FEI for having us. This was a real pleasure and joy. I'm probably speaking for everyone on the stage. And thank you for taking the time to hear our story.
Good.